The history of real estate markets is not a story about buildings alone. It is a story about security power and the human need to anchor wealth in something that feels solid when the future does not. When I look across centuries of property markets, I do not begin with mortgages or zoning laws, but with land as survival itself. Long before stocks or bonds existed, land was food shelter status and authority. To own it was to reduce uncertainty in a world where uncertainty meant death. Real estate became the first great store of value, not because it was liquid or efficient, but because it was visible, enforceable, and deeply intertwined with political power. In agrarian societies, land markets were inseparable from hierarchy. Ownership was concentrated through conquest, inheritance, and royal favor. There was no market in the modern sense. Land changed hands through marriage, war, or decree. Value was stable, but illiquid. Returns came slowly through rents and harvests. For elites, real estate was not an investment choice, but an identity. For peasants, access to land defined freedom or bondage. This is the first enduring lesson of real estate history. Property markets always reflect who has power to exclude, not merely who can pay. The medieval period preserved this structure, while quietly laying groundwork for change. As towns grew and commerce revived, urban property began to matter alongside farmland. Shops, workshops, and warehouses introduced a new logic. Location could amplify productivity. A plot of land inside a city wall was not valuable because of soil, but because of proximity to trade and protection. Here, real estate began its long association with infrastructure. Roads, ports, and walls raised values. Neglect destroyed them. Even then, property cycles emerged, driven by migration, war, and plague. After the Black Death, land values fell, while wages rose, reminding us that property prices don't move independently of labor and demographics. The early modern era transformed real estate into a financial asset. As states centralized and legal systems strengthened, property rights became more standardized and enforceable. Land could now be bought, sold, mortgaged, and inherited with greater certainty. In England, enclosure converted common land into private property, displacing rural populations and forcing them into cities. This was not just a social revolution, it was a real estate one. Property markets expanded by redefining who could own and who could not. Wealth shifted from communal use to private title, embedding inequality into the landscape itself. Colonial expansion globalized real estate logic. Land was surveyed, mapped, and commodified across the Americas, Africa, and Asia. Property values rose not from local productivity, but from imperial demand. Cities like New York, Buenos Aires, and Bombay became speculative frontiers, where land appreciation outpaced economic reality. Real estate booms flourished where governance was weak and expectations were strong. This pattern would repeat endlessly. Optimism capitalized into land prices long before income could justify it. The 19th century Industrial Revolution marked a decisive turning point. Urbanization accelerated at unprecedented speed. Housing demand exploded as workers flooded into cities. Real estate markets became volatile, speculative, and politically sensitive. Slums and mansions grew side by side. Landlords extracted rents from necessity rather than luxury. Governments, slow to respond, discovered that housing was not merely a private market, but a public risk. Cholera, fire, and unrest revealed that unregulated property markets could destabilize entire cities. Zoning laws, building codes, and public housing emerged not from benevolence, but from fear of disorder. By the early 20th century, real estate had fused with finance. Mortgages expanded access to ownership while increasing leverage. Property cycles intensified. The real estate boom of the 1920s, particularly in Florida, demonstrated how credit could inflate land values beyond utility. When the Great Depression arrived, property prices collapsed, banks failed, and households lost homes en masse. This crisis etched a deep lesson into financial memory. Real estate feels safe until it is leveraged. Governments responded by reshaping housing finance, introducing long-term fixed mortgages, and state-backed lending to stabilize both banks and families. The post-World War II era produced what many still regard as real estate's golden age. Suburbanization, highway construction, and mass mortgage availability transformed housing into the centerpiece of middle-class wealth. Home ownership became policy culture and aspiration. Property prices rose, steadily reinforcing the belief that real estate was not just shelter, but a guaranteed path to security. This belief mattered more than data. It shaped savings behavior, voting patterns, and urban form. Real estate ceased to be one asset among many, became the emotional core of personal finance. Yet history rarely allows such narratives to remain unchallenged. As cities globalized in the late 20th century, real estate markets diverged sharply. Prime urban land became a global asset, absorbing international capital disconnected from local incomes. Housing shifted from use value to investment vehicle. Prices rose not because people earned more, but because capital searched for yield and safety. Inequality was etched directly into geography. Ownership created wealth. Renting preserved vulnerability. Real estate once again revealed its dual nature, stabilizer for some, barrier for others. The early 21st century exposed the danger of this transformation. The global financial crisis of 2008 was at its core a real estate collapse, amplified by leverage opacity and misplaced faith in perpetual appreciation. Housing markets that had been treated as engines of stability became triggers of systemic failure. The aftermath reshaped regulation, but not belief entirely. Even after collapse, real estate retained its aura of safety, demonstrating how deeply psychological property markets truly are. Across this long history, one truth persists. Real estate is never just an asset class. It is where finance meets daily life, where markets intersect with identity, family, and belonging. This is why property cycles generate not only booms and busts, but anger, nostalgia, and political backlash. To touch housing is to touch legitimacy itself, and it is here at the point where land has evolved from survival to speculation, from shelter to global store of value, that the history of real estate markets confronts its most unresolved question, because property promises stability while generating volatility, security while amplifying inequality, and the future of real estate will depend not only on interest rates and supply, but on how societies choose to balance homes as places to live against property, as instruments of wealth, as the story moves toward that accumulation of tension, because history shows that real estate markets reach their most unstable phase when their social function and financial function drift too far apart. When homes are treated primarily as balance sheets rather than places to live, the market begins to price expectation instead of utility. And expectation is always more volatile than shelter. This is the condition that defines the modern era of real estate, where global capital, low interest rates, and policy incentives converge on a finite resource location. In the decades following the 2008 crisis, real estate did not retreat from finance. It deepened its entanglement. Ultra-low interest rates transformed property into a yield instrument. Investors chased rent streams and appreciation as substitutes for bonds. Cities with strong legal systems and global connectivity became magnets for capital, regardless of local affordability. The result was a widening gap between prices and incomes, a pattern familiar to historians, because it has preceded every major property reckoning from ancient Rome's latifundia to 19th century urban land booms. What differs today is scale. Capital moves instantly. Demand is global. Supply is slow. The imbalance compounds. History also reminds us that governments are never neutral observers in real estate markets. Property has always been political. Taxes, zoning, infrastructure, credit policy, and ownership law determine who can buy, where they can build, and how prices behave. In the post-war era, states promoted homeownership to stabilize societies. In the late 20th century, they deregulated finance to expand access. Each intervention solved one problem and created another. When prices rose, homeowners felt secure. When prices rose too far, renters were excluded. Stability for one group became fragility for another. This trade-off is not accidental. It is structural. Urban history sharpens this insight. Cities thrive on density, yet property markets monetize density by excluding those who generate it. Workers are pushed outward as land values rise inward. Commutes lengthen. Infrastructure strains. Social trust erodes. These patterns appeared in London during the Industrial Age, in New York during the Gilded Age, and in global cities today. Real estate cycles are not confined to price charts. They redraw urban life itself. When housing becomes unaffordable, labor markets distort, productivity suffers, and political backlash follows. History shows that housing crises rarely remain housing crises for long. Another recurring lesson is that real estate cycles are slower, deeper, and more emotionally charged than other asset cycles. Stocks can crash and recover within years. Property markets move over decades because they are anchored in credit contracts, family decisions, and local politics. This inertia masks risk. Booms feel permanent. Busts feel personal. When downturns arrive, they are experienced not as losses on paper, but as ruptures of identity and security. This is why property crashes generate long shadows of mistrust and policy reaction. Yet history does not suggest that real estate must inevitably produce crisis. Periods of relative stability have existed when supply expanded alongside demand, when credit was disciplined, and when housing policy prioritized use value alongside ownership. Post-war social housing programs, rent regulation, and cooperative ownership models did not eliminate markets, but they moderated extremes. These arrangements were not perfect or permanent, but they demonstrate that outcomes are contingent, not predetermined. Real estate markets behave according to the rules societies choose to impose and enforce. As we look forward, the next chapter of real estate history will be shaped by forces older eras never faced simultaneously. Aging populations, climate risk, remote work, and financial abundance colliding with physical scarcity. Coastal cities confront rising seas. Interior regions confront decline. Offices empty while housing remains scarce. These shifts challenge the assumption that location alone guarantees appreciation. History warns us that when long-held beliefs about property permanence are questioned, capital moves, quickly often amplifying volatility before new equilibria form. The enduring lesson from the history of real estate markets is therefore not about timing or tactics, but about humility. Property has always felt safe because it is tangible, yet it has never been immune to cycles because it sits at the intersection of money law and human expectation. When any one of these shifts, prices follow. Those who understand real estate historically recognize that its greatest risk is not collapse, but overconfidence rooted in memory of the last cycle rather than awareness of the next. If this journey through the long history of real estate has reshaped how you think about land, housing, and wealth, I invite you to subscribe and continue exploring these financial histories with me. and to leave a comment, sharing which era of property markets you believe most resembles today. Because history does not tell us where prices will go next, but it does tell us why societies repeatedly return to land in search of certainty, and why that search so often ends by reminding us that even the ground beneath our feet is shaped by human choices rather than destiny.